Well, I'm already having a good day, even though it's first thing in the morning, because I'm getting to do two of my favorite things, attend Finovate and visit Hong Kong. So thanks for joining me this morning. Yesterday, and really at every Finovate, we talk about this word disruption. It's been going on for a while now. We're really 10 years into a cycle of digital disruption and other forms of disruption in the banking cycle. But with apologies to William Gibson, what I think about disruption, I like to say that, much like he says about the future, it's already here. It's just not widely distributed yet. I noticed that Chris Skinner was here yesterday, one of my other favorite things. I saw he talked a lot about legacy thinking, legacy technology, legacy management, and that's one of the things that really gets hurt during times of disruption. And I stand here today at nearly the end of October, the first month of the fourth quarter of the year 2018, again 10 years into this disruption cycle that started coincidentally with the start of the global financial crisis. And that was one thing to the industry, but maybe what we didn't notice were some of the other things, the rises of the new technology and so on. And the industry stands today at record profits, over $50 billion in the fourth quarter in the US alone, but the same story is true across Asia and across Europe and Australia and other countries as well. We're really at a very, very flush time. And then there's an old saying in banking, and for the lenders, and may know this, right? Some of the best loans are made in the worst of times, and some of the worst loans are made in the best of times. And I think the same thing happens to some of our management decisions. I think we've made maybe some of our best decisions in the worst times. And I worry a little bit now that we're in some of our best times, that maybe we're not making all the good decisions that we need to as leaders. So I'm going to talk about that today. I worry that we're feeling just as happy and as flush as BlackBerry felt in 2007 as they had record profits and record revenues of about $5 billion. And a lot of people know that what happened in 2006 was Apple launched the iPhone as a major disruptive event. But what a lot of people don't realize is that BlackBerry kept chugging along. They hit record revenues for each of the next 4 years. And if we're honest and we really think about what that must have been like to be in the management team of BlackBerry, the parent company then known as Research in Motion, this really felt pretty good. It was pretty easy to deny what was happening with Apple and the iPhone. Well, that isn't for our customers. Our customers don't want that. Our customers want what we have. They want the tactile keyboard, which I admit I did love. We want all the security. I actually happened to be on the Apple campus in 2011 and had some conversations with, I did not get to meet Steve Jobs, but I did get to meet Ron Johnson, who was the architect of the Apple Store. And we had a lot of conversations with their technology people about how the ring fence and the remote wiping and some of the other things were actually pretty powerful security features that banks were concerned about. And, I might have even felt pretty strong the next year, even though profits dipped a little bit in 2012. That was still the second best year we've ever had. And if we're honest and we think about what that must have been like being on that board or being on that management team, it was pretty easy to deny what was happening because we didn't feel it yet, right? The disruption was already here. It just wasn't widely distributed yet. And then, of course, we know what happened. And now, even though the BlackBerry's still around, they're back to about 2005 levels of revenue. And it reminds me of a great line in The Sun Also Rises, the classic Hemingway book, where they ask a millionaire how he went broke, and he said 2 ways: gradually, then suddenly. And that's kind of how disruption happens. So we're in this gradual phase right now in banking, and some of us are feeling the sudden phase already, particularly here in Hong Kong, particularly those of you from mainland China, as you see what's happening with Baidu and Alibaba and Tencent and Alipay. And I heard the Alipay session yesterday was a big draw. Everybody wanted to hear more about what was happening there. I was just in Las Vegas last week, and even in Las Vegas in the US, we've got Alipay signs on top of the taxi cabs right now. right? So we're still in the early stages of this. But we're seeing it already. We're seeing some of those early cracks. We're seeing some of the gradual parts. We look at digital lending. As recently as 5, 6 years ago, most of the digital lending really was taking place from the large banks. And now we're seeing this shift where the share from the digital players have grown almost eightfold just in a 5, 6 year period of time, where customers are choosing different preferences. They're choosing different ways to deliver. And the large banks are responding fairly well. It's an altogether different challenge for the smaller banks. And we have more of that problem in the US than we have in probably any other country where we're really very seriously overbanked. But it's happening everywhere. And your strategy works until it doesn't. Right, this person here says, we're strategically positioned better than just about anybody out there. Never in my wildest dreams would I have aimed this high. Well, maybe just a little higher would have been good. This was the director of digital strategy for Blockbuster in 2010. The company would file bankruptcy in October of that year, so this was just a few months before that. And you've probably heard somebody come and talk about Blockbuster at probably just about every conference that you've been to over the last couple of years. And I'm going to try to make a little bit different point because I want to take a step back before Blockbuster was the top of the industry and think about what the home video market was like. And then I'll try to tie that back into where we are in banking. Prior to Blockbuster coming around, the home video market was really dominated by small mom and pop players, right? Very small stores, a couple hundred square feet, a couple of hundred titles. My wife actually worked at one of these stores. It was in a little strip center in between a drugstore and a convenience store. And I remember trying to rush there to get there by 5 o'clock on Friday so I could rent Beverly Hills Cop, and being disappointed when I walked out with Camp Beverly Hills instead, right? Not nearly the same movie because it was difficult to maintain a very good inventory. The videotapes back then, even before we switched to DVDs, were very expensive, and it was hard to have a lot of efficiency in this business. Well, then Blockbuster came along, and they really put scale and efficiency into the home video business. So they had regional warehouses, and they had 10,000 square foot stores in Class A real estate in all the best neighborhoods. Right? Every neighborhood had many Blockbusters on some of the most expensive corners. And this is true in most of the cities in the world, certainly true all across the United States. Through the regional warehouses and the barcodes that they used on the movies, they were able to match supply and demand so that you didn't have that disappointing experience like I just described, because they were able to really match that up. Then the apocryphal story goes in 1997, an engineer named Reed Hastings supposedly rented Apollo 13, brought it back a couple of days late and had $40 in late fees. And so in the first of what we see over and over again as a pattern of disruption is an entrepreneur says the status quo isn't good enough, we can do better. And you know what he did. That was a little bit better. But again, think about being on the board in Blockbuster in the late 1990s, the early 2000s, when they commanded 40% of the home video market. They were opening a new store every 24 hours. They had 7,000 stores. And the business model here, initially, for Netflix was you go online and you fill out a form and we'll mail you a DVD, and when you're done, we'll mail it back. I don't think that seemed very threatening if I'm the head of Blockbuster at the time. I probably think, oh, isn't that cute? Our customers wouldn't want that. They want to come into our stores and talk to our highly trained staff because we're going to recommend movies for them. But of course, Blockbuster had a massive disadvantage to Netflix relative to the database that they were building on people's movie preferences and the cost advantage. And when they were able to reinvest that into the digital platform, you know what happened to Blockbuster. And you may also know, or maybe not, that in 2001, as Reed Hastings was having trouble scaling Blockbuster, or Netflix rather, he offered to sell to Blockbuster for $10 million. $50 million, I believe, was the number. But anyway, he was turned down flatly because Blockbuster just figured Netflix would fold. So now, of course, this is all digital and it's a platform business. So what does this mean for banking? Well, my point is that Blockbuster won by executing the predominant business model of the industry better than anybody else, right? They were the best executors, they were the most efficient players, and they won until they didn't. Netflix didn't beat them at their own game, they changed the game. And think about what's happening in banking right now. This is the number of banks in the US, and again, I know the US is a little bit different than many of the other countries here because we have so many. But in the early 1990s, we had 14,000 banks, or the mid-1980s, 14,000 banks. I joined the industry in the late 80s. We saw at about 13,000 banks when I was there. And each of those gray bars there is a period of non-recession, so a period of growth, and then we have the clear spaces are some of the recessions. And you see that consolidation sped up a little bit during each of the recessions. But the point is that how banks won, today's winners through this period of time won through efficiency and execution, the same way that Blockbuster won. That's not what the winning strategy is today or going forward. It's really about adaptability. So it's not about executing the same business model better, faster. It's how do we adapt and how do we react to change for our customers. I mean, we've been used to being gatekeepers. If you want to borrow money, save money, move money, invest money, you came through us and we extracted a little bit of a toll along the way. And suddenly we're being disintermediated, right? We were the intermediaries, that the trusted third party between buyers and sellers and depositors and borrowers. And suddenly now, especially on the payment side and the commerce side, right, the payments isn't even a step anymore. And when you look at what's happening in China and in Hong Kong, it's even more dramatic. Even the ubiquitous octopus card, which is just a piece of plastic in most of our wallets here, but it really is a payment vehicle, right, being used for so much more than just getting a ride on the subway. So you really want to see what's happening in the future, you're in the right place here, because we're so much more advanced in what's happening in Asia. And if you think about even a longer period of time, think about what can happen in 20 years. Let's look back to about 1997 with this report on 60 Minutes.
And Wall Street isn't concerned that Amazon has never made a profit, not a dime. In fact, it lost $125 million last year. The company says it's investing for the future. Skeptics say it would have to sell every book being sold in the world today to justify its stock price.
I think my generation grew up with Sears.
And Amazon is worth 20% more than Sears is worth in market capitalization.
How do you view that phenomenon that Amazon today is worth more than Sears?
Investors are focused on the future. Amazon has growth potential that Sears doesn't.
A couple of geeks who sketched out some software could destroy Sears Roebuck.
That's the beauty of technology and the microprocessor. We've never seen anything.
Never seen anything like it. And of course, we look at what's happening with Alibaba and Tencent. We laugh at Amazon. It looks like a mom and pop shop in comparison. But it's really fundamentally changing. And you know the headline in the New York Times 2 weeks ago now, Sears, this great pioneer of retailing, an innovator in so many things, from catalog shopping to home shopping and so many other things, now files for bankruptcy and may not survive at all. So what does this mean to us as leaders? Well, it means we need to get serious about innovation. And that means we need to move beyond the innovation theater, right? The cool, sexy headlines of we have an innovation lab and we have ping pong tables and beanbag chairs and everybody wears hoodies. That's great, but that's not innovation, not in my book. And that's not what really is making a difference in the lives of our customers. It means we also have to get away from what my partner Jason Hendricks likes to call the fintech petting zoo. And I understand Louise Beaumont was here yesterday, and I understand she's used this phrase too, so maybe we have to settle that out of court, but it's a good one, and whoever I'm borrowing it from, thank you, because I think it's a good phrase. Going to a petting zoo doesn't make you a farmer, and coming to a great show like Finovate and seeing all these companies that you're going to see today and that you saw yesterday, if you don't do something with that knowledge and take it back to your bank to actually create different experiences for your customers, you're not really adding any value either. Because innovation is really two things. It's implementing new ideas that add value Two things: implementing, we have to just do them, not just have the idea. And secondly, they need to create value. Now, how they create value is up to you. It might be in the back office, it might be in terms of the customer experience, it might be creating efficiencies. But we have to create value and we have to innovate because the status quo isn't good enough. Now, I look at financial institutions across a maturity curve. We have a 5-step curve that we use, and at the very bottom end, exclusion, they're just really not doing anything. Thankfully, I'm not seeing very many institutions that are still stuck here, but there are some. Most of the institutions we're seeing are right about here. Our current database, we're averaging about a 2.3, meaning they know they need to do something, even if they're not exactly sure what to do. And we measure that across 7 key indicators across that. So they're pretty good at the depth and the breadth, meaning that the organization, both top down and bottom up and side to side, are pretty engaged in innovation. But where we really have the low scores are really the last 3 things there. The ability to experiment, to test and learn, not just execute the things that we already know. Speed, being able to move relatively quickly is something we're not very good at in this industry. And finally, being data-driven. So I want to talk about each of these things just a little bit today. As I understand the process that we're in banks and the pressure that we're feeling comes from both sides. First, this dynamic fintech environment is causing a lot of stress and it calls for a lot of change, but at the same time, we have to operate in this highly regulated environment. The move fast and break things ethos of Silicon Valley just really doesn't work inside our industry. But yet we still do have to change. So what we need to be able to bridge this gap is some sort of empirical approach to value creation. We can't just throw things at the wall and hope that some good ideas come out of that. Well, maybe if we have a large enough budget, we can get away with that. But most of us really can't. So we need to have some process that helps us create value. So modern agile business tools have been around just the last decade or two. Things like design thinking and lean and agile and lean startup and all of these kind of ideas that have really revolutionized the kind of thinking that's happening in Shenzhen and in Silicon Valley and in Silicon Alley in New York and in other places in London and other places around the globe. They haven't taken as much root inside our industry, partially because none of them are perfect standalone replacements of just push a button, now we're agile and all of our problems are solved, but secondly, because they need to be adapted for the highly regulated environment in which we operate. So my partners and I have spent the last really 4 years thinking really hard about this problem, and the process we come up with we call FIRE, and it stands for Fast, Iterative, Responsive Experiments. And I think every institution needs to go through a process like this. And let me start with FAST. So FAST means we want to shorten the time, shorten the gap between idea and results. We take far too long to take these ideas and actually get them to market. We want to work with them and perfect them internally, and we need to be much faster. Now, I'm from Seattle, as Greg said, and I spent really all night working on Pacific time, so this is kind of my late afternoon today, but late last night in the middle of my Seattle morning while I was here, I was talking to a bank who told me that their strategy was fast follower. And I told her, like I tell most of the banks when I hear this, that, well, more than likely, you're half right. You're probably a follower, but you may not be so fast. And the fast is the part that really matters, because being a fast follower only works if you're actually pretty fast. If you're not fast, what happens is you've missed the growth curve. If you wait until this is well accepted by everybody, it's the industry standard, you've missed the growth part of the curve. So being a fast follower only works if you're actually fast. So we also want to be iterative, meaning it's a process of continuous improvement. The other thing I see a lot inside financial institutions is this notion that innovation is a project that has a beginning and an end. Oh, we've got a project here, we're going to be innovative, and then when we're done with this, we'll be good and we can go back to doing what we always used to do. But it needs to be a process of continuous improvement, and it needs to be responsive, meaning that data should be what's driving our iterations. And if we don't have data, really what we're left with is opinions. And one of the most dangerous decision-making methods is what we like to call the hippo. That's the highest paid person's opinion. Have you made any decisions from your hippos in your organization? I think most of us had. You know, when Jim Barksdale was the CEO of Netscape, as they were first commercializing the first web browser, he had a kind of a famous saying. He said, if we're going to go with data, let's go with data. If we're going to go with opinions, let's go with mine. The highest paid person's opinion. So we want to replace our opinion with facts. And finally, they need to be experiments, meaning they're structured to maximize learning. You know, one of the phrases that I think has been misused a lot from Silicon Valley is this idea of fail fast. Well, I'm in favor of failing fast, but the point isn't about the failure. The point is about the fast, right? That we're experimenting, and what we're trying to do is, if we're going to fail, let's do it fast so that we can keep trying something else so we finally get to something that works. So we need to be able to structure to maximize learning, because we can't manage innovation like we manage a typical IT project. And what I mean by a typical IT project is, if you're going to replace your core banking system, if you're going to replace your loan origination system, you don't really want to experiment. That needs to work 100% of the time, the first time, and every time. And you're going to spend a certain amount of time understanding what the requirements are, who the users are, and so on. And that's exactly what you want to do when you're putting in something that where the outcomes are well known. But what happens when your goal is, hey, our average customer base is somewhere between age 74 and dead, which is where many of these banks are today, and we need to be more relevant to the so-called millennial customer base. How do you put that into a Gantt chart? How do you manage that? How do you know when you're done? We need to have experiments, right? And taking your big project and breaking it down into 26 two-week sprints, if you end up at the same place you knew you were going to end up with from the beginning, that's not really an experiment. We need to be able to test things and learn along the way, and every now and then we learn a fact so big that we actually have to pivot. Turns out that this whole notion that we thought this was heading is in the wrong way. A bank that we've worked with in the past, they had a whole idea around how they were going to cross-sell insurance, and they built a whole, not a whole platform because they were testing and learning, but they spent a fair amount of time building something out and tested, found out none of the customers cared. They weren't solving a problem that their customers cared about, so they completely pivoted and found out what they were hearing from their customers. They wanted better lending turnaround time, so they refocused the whole project to be a better lending platform. And so the keys to success here is we need to have in the middle what I like to call an internal accelerator. Now, an external accelerator is where nascent ideas go to become viable companies. What we need inside the bank is an internal accelerator so we can take those nascent ideas and make them viable in the enterprise. But in order to do that, we need to have a platform of foundational frameworks. And I believe every organization needs to have a declaration of innovation. That's the who, what, when, where, how, and why of innovation. We need to understand what we're shooting for. Are we just trying to extend the line, this line of growth that we're on, and most of the banks are growing at low to mid single-digit growth right now? If that's good enough, we just need to extend that. That's one set of things. And we have a set of core tactics and strategies that actually probably work pretty well. But what happens if we want to try to bend the line? We want to change the trajectory of that. If we're growing at 4 or 5% a year and we want to grow at 10 or 12% of the year, then those core tactics and strategies don't work as well. Now what happens if we want to change the line or jump the line and create something completely different? Well, then those tactics don't work very well at all. So we need those innovation strategies and tactics, those foundational frameworks that allow us to be able to test and learn and run that internal accelerator. And so this is an example of actually one of the clients we worked with earlier this year, helping create an innovation portfolio for them. And the way we got there was really through a portfolio playbook. And I'm going to go through this very quickly, that we could innovate around saving our expense or increasing our income, and we can do that in the current period. And guess what? Banks do that all day, every day right now. We call that the efficiency ratio. But if we want to have growth, we can't just keep doing what we've always done and say, well, but instead of 4%, we're going to grow it at 9% next year. We need to be able to do something different, so we have to invest in the foundation to fund that growth. And over time, our portfolio might change. We might be more invested in expense savings today, but over time, then we invest in those foundational savings, and eventually, as that begins to pay off, we invest more in growth. And so we have this whole portfolio that we're managing as we manage innovation. So I want to leave you with just a couple of closing thoughts here today. And first is a quote from Peter Drucker, who says that management is doing things right, but leadership is doing the right things. And the Kaizen model, popularized by the Toyota manufacturing system, says that we should spend half of our time making sure that we meet the standards, the very high standards we've set for our products and our people, but half of our time improving it. And in fact, half of that time really should be innovating, doing something new. So the now, the next, and the new. And so if you're on the front line, most of your job is about executing to our standards, hitting our numbers and hitting the quarterly numbers that we've committed to. But as you move up the organization, it's more and more important that you spend a little less time on that and a little more time thinking about the future and thinking about where the organization is going. There's another thing the Japanese have a saying they call tamahagone, and it's the steel-making process for the samurai sword, which is a blend of high-carbon steel for strength and low-carbon steel for flexibility. Our institutions, our financial institutions, are very strong, but we also need to be flexible. So we need to have both to be able to survive. And finally, this is what it looks like as we look out into the future. The path is foggy, and I know as bankers we don't like uncertainty, so we'd like to just stand here and wait until the fog clears. But we can't do that. If we take just a few steps down the road, heading in that direction, yes, there might be some obstacles, there might be a fork in the road, but we can't see them until we get a little bit closer, so it's important that we make progress today, because in the words of the great Alan Kay, the best way to predict the future is to create it. Thank you very much.